Well, welcome to 2025. You're about to enter a new golden age of prosperity. And in the next few minutes, I will show you exactly what to expect for housing, for interest rates. And this year, I'll even touch on Bitcoin, the Fed, and the IRS. So, same as last year, rather than making you wait until the end, I'm going to give you all the answers that you came for in the first 3 minutes. Then, if you want to go in depth as to the reasoning why, that will be covered in the remainder of the video. I believe that the market is literally pregnant with expectations. When the election was quickly called on November 6th and Trump declared the winner, it was like receiving news that you're pregnant. Excitement was through the roof, and the markets echoed that sentiment. January 20th, if you've been following the news since the election, will be like successfully completing the first trimester. Then we'll enter the second trimester, and that often brings awkward and uncomfortable changes. And by the third trimester, what nobody wants you to focus on is just how painful delivery can be. However, once we're through all that, the future will not merely look bright, it will actually be bright. But today is January 10th, and you need to both mentally and financially prepare for what's ahead. Here's what I fully believe that you can expect in 2025 and beyond. But first, a quick required legal disclaimer. This video is for informational and educational purposes only. Nothing is intended as investment advice. You should be fully aware that market moving events are often highly unpredictable and more accurately termed as being full of risk. The opinions expressed within this video are those of me, Mike Castronovo, and do not necessarily reflect the views and opinions of CMG Financial or CMG Home Loans. Okay, so here are the answers as promised. Housing. It's a continuation of my prediction in 2024. Real estate is local, and you'll see some areas do better and worse than others. However, overall, you will see home values continue to rise year over year on a national scale, both this year and for several years to come. Interest rates, also a continuation. Rates will not go down as fast as many continue to predict. However, when they do, they will ultimately go down much further than the so-called experts predict. Bitcoin. I've never commented on this in the past, so why now? A couple of reasons, but it does tie back to tangible assets such as real estate. So what's my forecast? All right, don't call me a hater before fully understanding what I'm saying. I believe digital currency is undeniably in our future. However, for me personally, the jury is still out on Bitcoin. So before you go all in on betting your life savings on an eventual $13 million future valuation, ask yourself, what would happen to its value if something even more secure and stable came along? All right, the Fed. I'm very optimistic that we won't live through an actual World War III. And if we do, nobody will be left to say that I was wrong. However, in the US especially, the upcoming battles between the incoming administration and the Federal Reserve Central Bank may end up appearing as its own nuclear war. I believe there's a better than 80% chance the Fed will be eliminated before 2028. Sounds like crazy talk, right? And if you stick with me through the end, I'll tell you why. Likewise, the IRS and personal income tax are living on borrowed time. I'll be a little bit more specific here, but we'll go deeper later in this video. I believe in the very near future, you will see a proposal for a sunsetting of the US personal income tax. I know, some pretty darn bold predictions, right? Why the heck should you take my word for it? For those of you who don't know me or my track record, I'll humbly tell you why. Aside from the fact that I have a history of calling both housing and interest rate markets correctly for the past 26 years, for reasons known only to God above, He has blessed me with a keen ability to make highly accurate market predictions ever since my junior year of high school, including many predictions that most people thought were outlandish at the time, but ended up coming to pass. I went on to become the youngest member in the history of the Chicago Mercantile Exchange, the CME, the world's preeminent financial futures and options exchange. While there, I built the largest institutional trading desk for options on short-term interest rate futures for over 7 years in a row. Head traders from many of the largest banks and hedge funds in the world were both clients and mentors who, as I learned from them, would also seek my advice, often on a daily basis. And I don't say this to brag, but to let you know that you're not listening to your typical mortgage guy who's going to parrot some in-house or industry economist and what they say, often with rose-colored glasses to fit their agenda. My forecasts have covered both good and bad markets, including calling the market top in real estate in 2007 ahead of the crash in '08. That prediction, along with advice on how to position yourself to safely and successfully navigate through that period, earned me a lot of business. A lot of clients credited me with helping them save their homes during that time. All that to put it in context, when I say that we're about to enter a new golden age in the US economy, you can rest assured that it's not coming from someone who's just drinking someone else's Kool-Aid. It is, however, coming in the context of what I believe a Trump presidency will mean. Now, this is not meant to be political, but the facts are unavoidable, meaning you cannot predict what will happen to housing and interest rates outside of considering Trump's agenda. And trust me when I say it all ties together. So much so that it's hard to pick a place to start in order to explain the aforementioned predictions. To go fully into it, I could speak for 5 days straight and would still be connecting all the dots for you. But I'll do my best to dive into the deep end here and try to explain it all, specifically in relation to housing and interest rates. So let's start with all the doom and gloom predictions of a housing meltdown, collapsing real estate prices, and why this is all a bunch of bullcrap. As of November 26, 2024, Freddie Mac's updated estimates show that the housing market is still dramatically undersupplied relative to long-run housing demand. In case you're not familiar with who Freddie Mac is, they, along with Fannie Mae, are the two government-sponsored enterprises, the GSEs, that buy mortgages from lenders, pull them into securities, and sell those securities to investors. This process replenishes the funds of lenders so that they can make more loans to borrowers, and that keeps capital flowing into the housing market. Anyway, Freddie Mac's recent report concluded that despite adding 5.8 million housing units over approximately 4 years since their previous estimate in 2020, housing demand has increased by almost the same amount, meaning virtually no progress in reducing the housing shortage. They estimated that U.S. housing supply is 3.7 million units below what is needed given our current population. They also estimate over 1 million households, comprised mostly of millennials and young adults entering the housing market, have remained renters due to high mortgage rates. High rates obviously put a damper on affordability. Rising home prices due to inflation have also had an effect and are directly related to the shortage of supply. That's because while building more houses is essential, builders are also contending with high interest rates and higher cost of materials. You've heard it all throughout the Trump campaign that day one action item will be drill, baby, drill. Reversing inflationary policies of the Biden administration is at the top of Trump's agenda. Lower oil and gas prices means lower cost of transporting goods across all areas of the economy. That means everything from lower grocery bills for consumers to lower costs of lumber, steel, and other building materials. Lower cost to build means keeping housing prices more affordable. Slowing inflation will also eventually lower rates. Why is this so important? Well, many so-called experts will try to tell you that rates at these levels are simply the new normal. Here's the problem with that. In July 2024, the median U.S. home price was $427,300. Assuming a 5 to 10% range down payment, that would put the median first-time homebuyer mortgage at about $400,000. Mortgage rates play a dramatic role in demand. Think about this. 30-year fixed mortgage rates have gone from roughly 3% in January of 2022 up to nearly 8% in October of 23, back down to a little under 7% as of today. This would mean, on average, in order to buy a home at that median $427,300 price point, you would need to earn about $114,000 annually at a 7% interest rate. At an 8% rate, you would need to earn $126,000 a year. At 3%, you would only need to earn about $73,000. In other words, a person or a couple who could afford that home at 3% would need to earn 73% more income in order to buy that same home at 8%, or earn 50% more income to afford it at today's rates. Another reason that rates will need to come down is commercial real estate debt. When you see the clickbait headline predictions citing those like Warren Buffett and Grant Cardone saying that real estate is about to crash, They're talking about an estimated 2.7 trillion in commercial real estate debt that is coming due for refinance at rates that are more than double what these borrowers are currently paying. One thing that I can guarantee you, as those commercial loan losses start to pick up, the markets will start to quickly adjust rates lower until the commercial world starts to stabilize. Again, I won't go deep in this video because I already told you this would be coming back at the beginning of 2024, along with the next reason. This last reason that rates will come down much farther than people realize is the current US national debt, which is about to pass 36.3 trillion and will pass 37 trillion before the end of spring. It's currently growing at roughly 1 trillion every 100 days. Notice I did not say that the Fed will lower rates. I said that rates will come down. Here's a quick lesson on how it works. When you hear the Fed is cutting rates, that means they are lowering the target rate for the overnight rate that banks lend each other. Everything from 1-month treasuries to 30-year fixed mortgages is all driven by the free markets. The Fed has no direct control over mortgage rates. The Fed funds rate is what banks lend each other overnight to either meet their nightly reserve requirements or to put their excess reserves to work. This is the rate that affects the bank's prime lending rate, which is generally 3% above the Fed funds rate. So this will have a very close effect on things like home equity loan rates, credit card rates, and commercial business loan rates. Lowering these rates can immediately spur the economy. But when you have an economy where inflation is already high, spurring more activity is only inflationary, and so longer-term rates like 10-year U.S. Treasuries and 30-year mortgages actually go up in response, which is exactly what we've seen since the Fed started cutting rates in September. Mortgage rates went up at the exact point the Fed cut rates here, here, and here. So why did the Fed cut rates? Didn't they know that this would be raising mortgage rates? Of course they did, with 100% certainty. So why? In short, the establishment is doing everything they possibly can on their way out the door to set up Trump for failure, especially in the first 100 days. President Trump does not like Fed Chairman Jerome Powell, and Powell does not like Trump. After the Fed's second unnecessary rate cut on November 6th, Powell was asked if he would leave.
Hi, Victoria Guida with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
And Trump was asked if he would ask him to leave.
Will you try to replace Jerome Powell?
No, I don't think so. I don't see it. But I think if I told him to, he would. But if I asked him to, he probably wouldn't. But if I told him to, he would.
Let me read between the lines for you here. Trump is happy to let Powell take the blame for any landmines left behind, and he's on the record as saying that he won't ask him to leave, but he's clearly left the door open that he could tell him to leave. So on to other things. It's hard to keep up with all the news of wrongdoing that keeps surfacing on a daily basis, the latest of which came in a couple of days ago. According to the New York Post, U.S. Treasury Secretary and former Fed Chair Janet Yellen has warned Congress that the U.S. will reach its new debt limit between January 14th and January 23rd, and that this will necessitate the use of, quote, extraordinary measures in order to avoid a U.S. default on debt. In other words, after sending yet another $2.5 billion to Ukraine the week prior, she is now throwing up the red flag saying, oops, looks like we're out of money to pay our own debts to run the government. I think they underestimate Trump, even though they should know by now that he doesn't play by establishment first rules. He didn't run for money or for power. He had more than he needed and with nothing left to prove. He's in that office because he loves America and sees a real risk posed by those who are hell-bent on destroying it for a one-world government controlled and run by the elite who sincerely believe they know what's best for you. Trump sees what's coming at him. He's not the least bit worried. I think the biggest reason why is that he knows he'll use their strength against them like a 10th degree black belt in judo. Imagine this. You want to shut down the government? Be my guest. That's on you Democrats and rhinos. Everything, and I mean every single bureaucratic office and pork belly project, is shut down automatically rather than Doge needing to do it. Now it becomes a simple matter of executive order funding the necessities of what absolutely needs to be paid for. Social Security, Medicare checks all go out, military pay goes out, interest payments to our creditors to avoid default go out. Then Doge simply goes down the list determining what needs to come back online and leave the things that don't shut off. How quick do you think the Dems and rhinos will come running to the table begging for an opportunity to negotiate? Think it won't happen? Remember, you heard it here first. The issue of the national debt and the debt ceiling is under congressional authority. While the president can advocate for raising the debt ceiling, only Congress can actually raise it. In situations where the debt ceiling is reached, the Treasury Department may take extraordinary measures to manage cash flow and meet obligations temporarily. But this is not a solution that can last indefinitely. Now, here's the historical context. There have been discussions and debates about whether the president could invoke certain constitutional provisions to act unilaterally in extreme circumstances, such as the 14th Amendment, which some argue could allow the president to ignore the debt ceiling. However, this interpretation is controversial and has not been tested in practice. But let me ask you, given his track record in legal battles, do you think President Trump will hesitate being the first to test it for the reasons I just listed? Therefore, if it comes down to it, Trump would utilize the impending crisis to leverage negotiations, ensuring essential services remain funded while eliminating waste and redundancies. Now let's talk about personal income taxes. Eliminating personal income taxes isn't just a dream, it's a feasible goal if we strategically rethink our federal revenue sources and cut unnecessary spending. Historically, the U.S. government has relied heavily on tariffs. But, like the frog in the boiling pot of water, they slowly started turning up the heat on us back in 1913 through today, collecting less and less revenue from tariffs and more from personal income taxes. For example, in 2023, the federal government collected around $4.7 trillion in taxes and only $80 billion derived from tariffs. Imagine if we increased tariffs to 25% across the board. This could generate an estimated $1 trillion, making up a significant portion of necessary revenues to fund government operations without resorting to taxing citizens' incomes. This would align with the historical precedent where over a century ago, tariffs funded nearly all federal expenses. By shifting to a tariff-based revenue model while reducing personal income taxes, we could advance a climate of financial freedom for citizens. This approach would alleviate the burden on households, allowing them to retain more of their earnings while alleviating recent pain of inflation. This may sound like the exact opposite of what you've been hearing from those on the left. But think about this. When you look at the breakdown of the average American household's spending, a large portion is not affected by tariffs. Things like rent, mortgages, utilities, gas bill, insurance. But if you look at all the items that could be affected by tariffs, household equipment like TVs, washing machines, and toasters, new car purchases, clothing, and if we toss in all other non-itemized expenses, it totals about $9,896 per year, or approximately 12.6% of the income for a household making $78,635 annually before taxes. Even though many of those goods are made in America, for argument's sake, let's assume that 100% of those items are imported, so a 25% increase would raise that average American's out-of-pocket budget by $2,474 a year. However, that same household was paying $9,032 in federal income taxes. If you lower or completely eliminate the income tax, that average American is now ahead by over $6,500 every year. Now, all of a sudden, that higher priced home becomes more affordable even before interest rates start to drop. However, to fully realize this transition to no personal income tax, we must couple it with a rigorous audit of wasteful government spending. Current estimates estimate that around $400 billion annually is lost to improper payments within the health insurance programs alone. Curbing these inefficiencies could be instrumental in reducing the revenue shortfall faced by the government. By tackling inefficiencies like this, we could make a significant impact without adding burdens on taxpayers. Now imagine what could happen if we paired this with a gradual phase out of personal income tax. Those already receiving Social Security benefits wouldn't be affected, but new workers entering the economy would enjoy a zero income tax environment. This could boost consumer spending, fuel economic growth, and create new opportunities for entrepreneurship. This isn't just pie in the sky thinking. It's all about aligning policies with smart financial principles. The goal? Lower the overall tax burden, energize the economy, and empower businesses to thrive. Let's also talk about the size and scope of the federal government. With about 450 agencies, nearly double the number of years the U.S. has existed, it's no wonder inefficiencies abound. Overlapping functions and bloated operations often lead to unnecessary spending. You've heard the phrase, the left hand doesn't know what the right hand is doing. In this case, the left hand often doesn't even know that there is a right hand. So now you have Elon Musk, known for his ability to streamline and optimize businesses, leading a new department of government efficiency. Through detailed audits and rigorous oversight, it's possible to identify and eliminate wasteful spending. For instance, improper payments across sectors already total hundreds of billions of dollars. A thorough review could easily uncover over $1 trillion in savings, funds that could be redirected to bridge revenue gaps without increasing taxes. But what if we went further? Cutting down bureaucratic overhead and focusing on smarter spending could also help rebuild trust in government. Currently, about 23% of federal revenue goes towards interest payments on the national debt. Reducing that debt with disciplined fiscal policies would free up resources for public services and long-term investments. What about the workforce? The U.S. government employs roughly 20 million people across federal and state levels. Reducing this workforce by 50% could save an estimated $750 billion annually in salaries alone. Now, some might ask, isn't cutting 10 million jobs too extreme? Think of it this way. In most workplaces, employees are held accountable for meeting productivity standards. If they don't, they risk losing their jobs. Shouldn't the same principle apply to government employees? After all, they're funded by your hard-earned tax dollars. If positions are inefficient or redundant, wouldn't it make more sense to transition those workers into roles where they can contribute meaningfully to the economy? Streamlining government operations could do more than save money. It could spur private sector job creation, enhance productivity, and pave the way for a stronger and more sustainable economy. And it's not just about slashing jobs or cutting red tape. It's about smart regulation, making rules that support growth rather than hinder it. By removing unnecessary obstacles, we can create an environment where businesses thrive and innovation flourishes. At its core, improving government efficiency is about creating a better future for everyone. It's about revitalizing our economy, reducing financial stress on families, and building a system that works for the people, not against them. All this points to a more prosperous, financially secure America, which means a continued strong housing market. Now let's talk about the Fed and why I believe there's a better than 80% chance of seeing it eliminated prior to 2028. Did you know the United States hasn't always had a central bank? That's right. The Federal Reserve, or the Fed as we call it, was created in 1913. What most Americans don't know is that the Federal Reserve is not part of the U.S. government, as its name would imply. Rather, it's a privately held corporation, and here's where people get easily misdirected, but you should pay close attention to this. The Federal Reserve is not a private, profit-making institution. However, the stock of the Federal Reserve banks is owned by banks, not individuals. The Federal Reserve banks are set up like private corporations, and member banks hold stock in the Federal Reserve banks and earn dividends. Congress does have a constitutional obligation to oversee the Federal Reserve's use of its powers. Congress can review the Fed's activities, alter its responsibilities, and ensure it achieves economic objectives. The Fed chair must also submit a semi-annual report to Congress on monetary policy. But in terms of authority, Congress delegated monetary power to the Federal Reserve at its creation in 1913 through the Federal Reserve Act. Since its creation, the Fed has played a big role in allowing unchecked government spending. After we moved off the gold standard in the 1970s and started relying on paper money, meaning that the Fed could print as much of it as it deemed necessary, we've seen inflation and economic instability. Now that we're dealing with massive debt and a shaky economy, more and more people are calling for the Fed to be abolished, and I'm going to share how that could actually happen. People argue that the Federal Reserve was created to stop banks from failing, but many of those failures were due to fraud rather than a broken system. The Fed provides a way for banks who are in trouble to borrow from each other to avoid failure. Not completely bad. However, this takes away the risks that motivate banks to be responsible. Now we're feeling the consequences of these policies. If the Fed were gone, it could really limit government spending and help banks act more responsibly. But can we really do this? Well, back in 2007, Ron Paul introduced a bill to abolish the Federal Reserve. It could take just a year to make this happen by selling off Fed's assets and moving its responsibilities back to the Treasury and regular banks. This would remove a monopoly on money creation and bring back a healthy dose of competition. Just imagine interest rates based on real market conditions rather than a central authority's choices. If the bad banks fail and there are no bailouts, banks will have to be smarter with their decisions. Each bank would work to earn trust and keep their operations safe, ultimately benefiting everyone in the long run. The impact of the Federal Reserve has been significant, but it's not too late to push for change. Ending the Fed and shifting back to a better monetary system is feasible if we have leaders willing to take that leap. Again, if ever there were a moment in our lifetimes for this kind of change to occur, I think this is it. Now, turning to Bitcoin, I believe the transformative potential of digital currency, especially if backed by tangible assets like gold. Again, not a crypto hater, just offering some healthy words of caution. Bitcoin, as of this recording, is trading at approximately $91,800 after reaching a high of about $106,490. It's down about $15,000 in the past month. Pause here to think about the irony of the crypto world for a moment. The value of Bitcoin is quoted and traded in US dollars. Anyway, free markets are all about price discovery. For example, you can look at the Bitcoin futures market on the CME. There's somewhere in the neighborhood of 35,000 to 40,000 contracts that are betting on the current price of Bitcoin. 40,000 contracts believe that it'll go up, and 40,000 believe it'll go down. There's always a 50-50 split. If more people think it's going up than down from the current price, then it will rise to the point where the market is betting the odds are 50-50. If it's 55% of the active traders in the market think it's going down and only 45% think it's going up from the current level, then prices will fall until they reach a 50-50 equilibrium. So when someone tells you the market is going up to a certain level, while they might believe it and have amazing research and reasoning to back that belief, at the moment, the rest of the market is split 50-50 on their thoughts of where does it go next. The next cautionary sign that I hear pretty frequently, BlackRock bought $1 billion worth of Bitcoin on the eve of the last dip. As of December 20th, 2024, BlackRock owns over 553,000 Bitcoin, which is around 2.6% of the total supply of Bitcoin. That's roughly $50.8 billion worth of Bitcoin, and that's impressive. However, consider that BlackRock has over $10 trillion in assets under management. That $50.8 billion in Bitcoin represents 0.5% of their managed assets. To help with perspective, let's say that you have $1 million investment portfolio. If you invested the same percentage as BlackRock, then you would invest about $5,000 of your $1 million portfolio in Bitcoin. In other words, when you put it in perspective, it's not as if BlackRock has made some major bet on the future of Bitcoin. When you manage as much cash as BlackRock, you need places to diversify your holdings. They already own 2.6%. What if they bought up 10% of that finite supply of Bitcoin? The problem becomes what happens if and when they want to sell. They have to do it when everyone is crazy about buying it. Otherwise, they will simply push the price down on themselves. Another thing to keep in perspective is that it's a digital asset. There is no tangible value like gold or real estate. If it were the only digital currency, because of its limited supply, it could be a greater store of value, assuming the entire world would accept its price, quoted in dollars, as an acceptable form of exchange. But there are multiple digital currencies, and all of their prices are still volatile. Let's say, for example, that you make bicycles and I want to buy a bicycle from you for $500 in Bitcoin. We agree, and you say, come back in a month and I'll have your bike ready for you. I come back, and like this past month, Bitcoin's value has fallen 15%. So now you're only receiving $425 in Bitcoin, depending on the day we locked in the value of our purchase contract, and that can severely cut into your profits. Now you go out to dinner, and maybe the value of Bitcoin has gone down another 5% because it's volatile. Now, what you thought was $425 in your digital wallet is now only going to buy you about $403 worth of dinner, concert tickets, and parking. On the positive side, the more owners you bring in, the more stable it can become. Unless a few big players end up controlling a substantial portion of the available Bitcoin, in that case, they can move the market dramatically based on their size. With the value of our dollar being destroyed by Congress's overspending and printing more and more money to do so, being tied to the US dollar is not necessarily the most stabilizing way to go. Tying Bitcoin's value to gold, on the other hand, could bring much more stability in that investors would know there is something of true value behind it. This approach could engender a new wave of trust and stability in digital currencies. However, there is at least one other emerging threat. Google's Willow quantum chip represents a leap in technology that can jeopardize current crypto encryption. This new chip may disrupt the foundational security of cryptographic systems like Bitcoin. How could that be? In easy to understand terms, you could say that encryption safety is largely based on how long it would take one of today's fastest supercomputers to break the code. Imagine encryption so strong that it would take 10 septillion years for today's fastest supercomputer to hack. 10 septillion, by the way, is 10 with 25 zeros behind it. Now, along comes Google's new Willow chip, and instead of 10 septillion years, it can perform the same amount of calculations in just 5 minutes. We must remain vigilant about these advancements and prepare the crypto landscape with quantum-resistant algorithms. Though we are not facing an immediate crisis, understanding these dynamics is crucial for future security. Returning to Trump's agenda, notable themes include his strategies for national economic renewal, particularly leveraging tariffs as a tool for economic advantage. Drawing parallels to President William McKinley, who navigated economic recovery through protective measures, Trump's approach could yield similar robust growth. Like McKinley, Trump's administration must strike while the iron is hot, acting decisively to bolster structural economic policies. If President Trump executes his plans effectively, perhaps unimpeded by internal party struggles, we stand on the brink of an era marked by prosperity. Let's face it, in reality, there's no longer a Republican Party and a Democratic Party. There is an America First Party, and there is a Globalist First Party. And at the moment, you have a group of rhino Republicans, Republicans in name only, in the middle, that in many ways can tip the balance of power. In one sense, you can argue that this gives them a lot of power and control. However, they have to confront their own future survival amidst a shifting political landscape. If they support Trump, they help usher in what will likely be the greatest economic period in U.S. history. If they impede Trump, They will be gambling on being able to hide behind what used to be the mainstream media, and their political futures may be as solid as CNN's latest ratings. Which, in case you haven't heard, CNN's primetime viewership since the election is down 49%, averaging only 378,000 viewers. Joe Rogan, by comparison, gets 14 million individual monthly listeners. All that to say, despite the fight he might face from the opposition, I believe Trump will wildly outperform his first term as president. So, in conclusion, I believe that housing will continue to rise, supported by solid economic fundamentals. Mortgage interest rates will eventually recalibrate to more historic lows, and eventually, contrary to what the so called experts out there are telling you, we will see rates below that 3% mark, albeit not overnight, a 90% probability that we will see it well before the 2028 elections. Conversations about affordability in real estate often miss the bigger picture. I suggest you ask, what would true affordability look like? Stabilization within the market is vital. Price corrections or drops could lead to unintended economic repercussions. To achieve a balanced housing market, we need supply to meet up with pent-up demand. Gradual price stabilization will be brought about by decreasing interest rates, increasing take-home pay via lower taxes, and perhaps most crucially, time. Rapid changes could reignite inflation, while delays could hinder growth. I'm an optimist, and I think we're about to enter an unprecedented time of economic prosperity. I'd love to hear what you think, so please leave your thoughts and comments below. Thank you for your time and allowing me to share my outlook for 2025. If you found value in this presentation, please like, share, and subscribe, and let's navigate this new golden era together.